Hi friends, so we have to talk about what are the common mistakes that are made by the finance team of startup ventures. So this titled is circumventing common financial traps in startup ventures. So that's the thing. So while we have to identify early stage traps, what are the numbers that you must look at? How frequently you should look at those numbers, and are the expenses realistic? So basically what one needs to understand is that as a chief finance controller of a startup, there are some specific numbers that you must look at, whether it is the gross merchandise value, GMV, or whether you're talking about the burn, whether you're talking about EBITDA, whether you're talking about runway, and then how frequently. So, in terms of the review frequency, is it like 7 days or 30 days or 60 days, etc.? And are the expenses realistic? The first trap is the uncertainty about what exactly are the key financial metrics that you must monitor. So, what is relevant to your business? And let's say what the VCs in general will look for if they are looking at investments in your company. So, for example, nowadays you talk about things like revenue, they talk about contribution margin 1, contribution margin 2, contribution margin 3, and then they talk about EBITDA. So, these are the relevant metrics that people now look at. So what you should look at primarily is that, okay, over the forecast horizon, what is my inflow of funds and what is the outflow of funds, and what is the money lying in the bank account? So like if it is like 500 is the inflow every day and 600 is the outflow every day, which means I'm having a burn of 100 every day. And if I have got 2000 in the bank account, which means I'm going to survive by 2000 divided by 100 is equal to 20 days. That's the basic maths. In case you are really burning the funds, you have to look at what is the inflow of funds and what's the outflow of funds, and accordingly, how the balance in the bank account is sufficient to help you survive. So we talk about burn, we talk about runway, we talk about growth rate and default alive. Those are very interesting concepts. Default alive, growth rate, burn and runway. So what does this mean? Now burn rate is the rate at which a company consumes its available capital to cover operating expenses before generating positive cash flow, which means what? In our example, we talked about money spent is 600 every day and money generated is 500 every day, which means the burn is equal to 100 every day. And therefore, the burn rate is the money spent divided by the time period. So for example, for us, it is 100 divided by 1 because our time period is 1. So it's like the burn rate is 100 per day. So for example, an illustration is that if you're spending like $50,000 per month on salaries, rental and other operating expenses and generating just $20,000 in monthly revenue, which means your monthly burn is $50,000 minus $20,000 is equal to $30,000. That's a very basic thing. How much are you making in a month and how much are you spending in a month and what's the delta? So runway will be what is the available fund. So in our case, it was like we had $2,000 in the bank account and our burn was $100 per day, which meant the runway is 20 days. That describes the length of the time that the company has until it exhausts its cash reserve. So let's consider a startup has got $200,000 in the bank. It burns $25,000 per month, which means what? The runway will be $200,000 divided by $25,000 per month is equal to 8 months. So that's what it is. So the growth rate is to assess the increase or decrease in a company's financial performance over a specific period. So the growth rate is inflow of funds in month 2 minus the inflow of funds in month 1 divided by inflow of funds in month 1. So for example, in the second month, my inflow is 200. In the first month, it was 150 and that was on a base of 150. So it is 50 divided by 150 is equal to 33%. So that's the growth rate for the company. So example, I had $500,000 of revenue last in May and then $700,000 in revenue in June. So growth rate will be $700,000 minus $500,000 divided by $500,000 into 100. So that's 40%. So just to repeat, I've grown like by a span of $200,000. So basically it is $200,000 is my growth. It was attained on what base? It was attained on a base of $500,000 and therefore into 100, which means the growth rate is 40%. Now, what does this mean? Default alive, yes or no? It refers to a financial state of a company where it can sustain the operations without the need for any external funding, primarily relying on positive cash flow generated from the business. So even if there is no funding, so this is basically meant that even if no funding, I will still survive. If I'm in a situation that, okay, I have got $2,000 and $100 per day is my burn, I'm going to survive only for 20 days. But let's say there is no burn in the business. Every day I'm generating a positive cash flow. So that's the key thing. So instead of minus 100, I am generating plus 100 every day. So considering a startup which has got $100,000 in monthly revenue, has got OPEX, etc. of $60,000 per month, which means it is generating a surplus of $40,000 every month, indicating that it is default alive as it can cover its expenses and sustain its operations without any external funding. So you are generating $100,000 in monthly revenue and you are just spending $60,000. So you are like default alive. You do not need any external funding to remain alive. The second trap is the frequency at which you monitor this whole thing. How frequently you should monitor the thing. For example, weekly, it could be a very intense review, or you can look at these numbers only annually, or maybe semi-annually, or quarterly, or monthly. But that depends upon the business intensity that you should be familiar with your numbers. So how frequently you should review it is a very specific use case to a business. And then downplaying expenditure. Some trap is like you're undervaluing your own time as a founder. So what is your opportunity cost is something that you must always be looking at, that what is the opportunity cost that you have. Employing individuals involves more than just their wages. It is a lot more in terms of that overall cost that is incurred. And assuming paid acquisition remains constant, so costs are subject to change. Identifying leads, you cannot outsource responsibility for your numbers. The numbers, the VCs or any stakeholder will expect that as a founder, you must have complete responsibility for your numbers. If you have a very rapid recruitment, look at the number of startups that have failed because of they've just ramped up their team very fast, irrespective of whether that team has actually be contributed to productivity, irrespective of whether the business outcomes are as intended. What does this lead to? This allows the runway to deplete significantly before initiating runway. So whatever is your runway, the moment you try to become very luxurious with all of your expenses, you reduce the runway from, let's say, 6 months to 2 months. So what is one of the trap is outsourcing responsibility. So who bears the responsibility for your figures? Is it the bookkeeper? Is it an accountant? Or even the CFO and CEO own the numbers? That's very important in an organization to understand that who are the people who are responsible for your numbers. And then rapid hiring. Each employee represents an investment in the company's growth. You have to be very, very particular that is there any value gained from each hire, justifying the initial and ongoing cost? Else, what is the whole point of hiring someone? So you need to measure the return on investment through employee performance and contribution. So the leaner that you are, the more logical is that you're going to survive well. And then letting the runway dwindle before starting the fundraising process. So you'll get under pressure if you started spending very extravagantly. So it's important that because that negotiation with VCs takes a lot of time, there are market fluctuations. For example, you have a funding winter, there are uncertainties where you are sustainable or not becomes a question. So your runway gives you leverage. So I will be far more confident about a startup which has got 20 months of runway as compared to 10 months of runway, because those negotiations might take a lot of time. the VCs might act pricey the lower your runway. So for example, if you have got a runway for just 2 months, imagine that you are literally in an intensive care unit in an ICU. So the kind of equity that you'll have to dilute, the conversations become far more against you in the whole bargaining process. So that's what it is in terms of the whole thing, in terms of the various traps that we looked at. It's important for you to look at all of these traps and beware that uh, you circumvent these common traps in a startup.